Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is ConocoPhillips, ticker COP. This company has a market cap of $133 billion, enterprise value of $143 billion. We see about $10 billion in leverage on this business. So for the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. Now, this operates in the oil, gas, and consumable fuels industry, which tends to be a cyclical industry, tends to be relatively poor in quality, but we will see if that plays out in the numbers. So they explore, produce, transport, and market crude oil, bitumen, natural gas, LNG, and natural gas liquids worldwide. Includes unconventional plays in North America, conventional assets in North America, Europe, Asia, and Australia. Unconventional usually means shale here, and they have LNG developments and oil sands in Canada. So founded in 1917, headquartered in Houston, Texas. So this is a pretty typical exploration and production company for oil and gas. Now, first thing you're going to see here is confirmation of what I was saying about cyclicality. They have 6 years of losses in the last 20 years. That indicates a relatively poor quality company. 6 losses in 20 years, that's 30% of the time. You are operating at a loss, and that is simply too much for me to consider investing myself. But we'll see what else we can learn as we dive on a little bit further. The other thing you'll see with this return on invested capital chart is extreme cyclicality. The oil industry is a commodity industry. You have cyclical prices, and that cyclical pricing means you're going to have some years that you make a lot of money, some years that you lose a lot of money, and some years somewhat in the middle. But usually it goes from one extreme to the other. That's very hard to predict. It's very difficult for investors to compound their money at a high rate over time when you have that up-down motion, and when in the troughs at the bottom, you have losses. Now, if the trough was still profitable, that would be one thing. But the fact that they're going into losses makes it really hard for management to plan, and it makes it really hard for investors to plan as well. So this cyclicality is a big problem and would suggest a low quality company. Now, the 10-year median returns aren't terrible. We're 10% return on invested capital, 14% return on equity. That means you're averaging out at least arithmetically okay. The problem is when you do a geometric mean, it's going to be lower than this arithmetic mean because you have to work in these negative numbers, and it tends to mean that your compounding is substantially worse than these numbers would make it out to be. So it's just something to be aware of when you see these averages. This is a low quality company here. Now, with that said, when we get to valuation, this becomes kind of an interesting issue. So you have a PE of 10. PE of 10 is a reasonable price for a company that's not growing, for a company that's relatively low quality. An average business might trade at a PE of 15 in the S&P 500, but a lower quality business, PE of 10, you're starting to get in the range of what might be reasonable. So maybe a PE of 10 is fair value as a starting point. However, the 10-year CAGR on revenue is a decline. And what we would say is declining businesses are worth less than a PE of 10. Maybe a no-growth business is worth a PE of 8, and a declining business even smaller than a PE of 8. The problem as well is that it's really hard to rely on these 10-year CAGR numbers because, you might say, oh, well, in 2012, we were doing quite good, but then in 2021, maybe we weren't doing well. So that's the difference between this $58 billion in revenue versus the $45 billion in revenue over the last year. But then again, you see some really big changes in numbers. I mean, look at the difference between 2014 and 2015. You go from $52 billion in revenue to $29 billion in revenue, a 43% drop. Or in 2020, you go all the way down to $18 billion in revenue, which was a 42% drop. So even though you had a 144% gain in 2021 over 2020, this is a very hard, difficult business to plan around, and it is what's leading to these losses and these up-down metrics. But look, when you just see on earnings per share basis, you've lost ground over the course of a decade. You have $6.72. You end at $6, and that's with losses averaged in there. So it's even worse on a PE basis than otherwise. That's something you have to remember when you're taking into account losses, is you have to punish the PE ratio for that. You have to take into account some sort of normalized number that averages in losses. If you don't do that, then you're going to overestimate valuation. What that means is that even at a PE of 10, this company is likely overvalued, and you're unlikely to get the compounded you would have for a company that didn't have these losses. If you're enjoying this video, hit that like button. Don't forget to subscribe. I'm uploading new videos each and every week. Monday, Wednesday, Friday, we're trying to hit 3 stock reviews every week. And so if you ring that bell, you can get notified when I upload new videos, and I'd like you to join me in the journey. So let's go to the income statement, see what else we can learn. SG&A is not a huge deal here. They're keeping it relatively low. You can see that they're actually lower than they were a decade ago, about 30% lower, and they've had to manage that very well. That actually looks like it's being managed well, but some of the stuff they just simply can't control because their revenue is driven by a commodity price. Their cost of goods sold is not. Sometimes this just flips into a really bad situation, and sometimes you make a lot of money. It's just not something that the management team, no matter how good they are, has strong control over. In addition, you can see that shares outstanding is kind of all over the place. It looks like from 2012 to 2020, they were steadily buying back shares, but then in 2020, they had to issue about 20 to 30% of their stock outstanding in order to keep the business alive because of these losses, and they wiped out a whole decade of share buybacks in a single year. Something to be aware of, something that is a little bit poor, or maybe this is an acquisition we'll have to see a little bit further. Balance sheet. You can see the property, plant, and equipment. Now, the nice thing here is they have reduced their property, plant, and equipment over time. They've been able to reduce their overall net investment, reduce their asset base, despite the fact that they're simply maintaining a level piece. So they're at assets of 153 billion, dropping down to 90 billion here. Let's see if we can see that acquisition here. Cash flow statement. Yes, you can see they did make an acquisition here. It's probably where some of this net issuance of stock came from and is driving some of that there. But again, big acquisition. The biggest problem I have is this company is not earning a sustainable cash flow. It makes it really hard to predict the future of this business. I could never own a business like this. You'd have to basically specialize in a cyclical company like this and try and time it. It's not a company you're going to want to hold over the long term because they don't have a sustainable, reliable compounding rate. Now, it can allow them to get big. You can make a lot of money buying the dips and selling at the peaks if you're able to do that. But I just don't think that's predictable. I don't think that's reliable in the long term. So for me, I avoid ConocoPhillips. If you enjoyed this video, hit that like button. Don't forget to subscribe. By becoming a subscriber, you can ring that bell and get notified as I upload new videos. I'm working through every company in the S&P 500. I've already done over 100 of them. You can click on the playlist where I've done those 100 plus S&P 500 companies already and look through the backlog as I might have already covered companies that you are interested in. As a subscriber, you'll get notified as I upload those new videos. But if you like this way of studying companies, if you want to do it yourself, consider joining quickfs.net. You can join as a free or paid member. Use the affiliate link that I have in the show notes right there in the description below. It should be the first link. You just click on it and you can head over there and it'll let them know that I sent you to do so. There's no cost to you to signing up through my link. No difference in price. It's just a way of supporting the show by using my affiliate link. Thank you for listening, and until next time, stop paying fees, start building wealth.